Hello, this is Ashley McHugh from Insurance Newsnet, and I will be the administrator for today's webinar, The Evolution of the Index. Moderating the webinar is John Hilton, Senior Editor at Insurance Newsnet. John has been with INN since 2015, following a long career in newspapers. He will be speaking with Sheryl J. Moore, President and CEO of Moore Market Intelligence. She is also the founder and creator of several competitive intelligence tools, including annuityspecs.com and lifespecs.com. Moore Market Intelligence specializes in providing competitive intelligence tools to the insurance industry, particularly the indexed life and annuity markets. The company also compiles quarterly reports on annuity and life insurance sales. Please ask any questions you may have in the questions pane during our discussion, and we will get to as many as we can at the end. And with that, I'll turn it over to John.
Thank you, Ashley, and thank you to everyone for joining us today. As most of you no doubt know, life insurance and annuity sales are doing very well here coming out of the pandemic over the last year or so. And index products are some of the biggest sellers. But there are concerns with these products. Regulators and consumer advocates say the indexes are confusing for consumers. And some of these products have been associated with some high-profile fraudulent schemes. And you add to that, the economy continues on its bumpy road. We saw some very distressing news this morning with the inflation data. That will no doubt lead the Fed to, again, increase interest rates when it meets. Today, we're excited to have Sheryl Moore back to talk with us. Mainly, we're going to cover indexed annuities today, but we'll also touch on some of the issues surrounding IUL as well. So with that, I'd like to welcome in Sheryl all the way from Des Moines, Iowa. How are you?
I'm great, John. Thanks for having me.
Before we get started, let's get a sense of who's in our audience. And Ashley, can you launch our first survey?
Yeah, the first question we have is, what is your role? Are you a financial advisor, an insurance agent, in distribution with a financial or insurance company, support or back office, or you're just interested? And we'll just give you a moment here to cast your ballot. All right, it looks like the majority of our audience are either with an insurance company or an insurance agent.
Great, thanks, Ashley. Okay, Sheryl, so let's set the stage for our discussion here today. And we need to start with the sales numbers for these indexed products. So why don't you give us a sense of where we are with indexed annuity sales and how big the market is right now?
Well, as you know, John, I'm a huge fan of indexed annuities and indexed life insurance. In fact, I'm wearing my I Love Annuities shirt today. I'll tell you, sales are really big, and I'm projecting that this is going to be another fantastic year for sales. We just passed our first quarter 22 sales report period, and indexed annuities came in at 16 billion in sales, which was actually a 15% increase over this time last year. But you have to keep in mind that annuity sales in general were up across the board pretty much, with exception to one-year fixed rate annuities. In fact, sales were the highest that they've been since 2008. So sales are doing really well. And we have the opportunity to experience some really great sales this year. Certainly, I think we're going to beat 2021 sales, but it's going to be a far reach if we want to really beat that record sales of 73 billion that we set in 2019.
Okay, so we know these products resonate with consumers, but why are indexed annuities so popular?
That's a great question. Indexed annuities and indexed life are really popular for a couple of reasons. They provide the potential for upside potential interest that's based on the performance of an outside stock market index. And that's achievable through the insurance company using about 3% of the consumer's money for options or derivatives that provide that index linked interest. But on the other hand, there's a floor of 0. So you can't earn less than 0% regardless of what the markets do. And I think that has been a real strong value proposition for index insurance products. We have to keep in mind that when the market is volatile, like it has been recently, that really helps indexed insurance product sales. So indexed annuities fare very well during market volatility, and so does index life. But the other thing that really helps to drive sales of these products is when fixed money instruments are crediting rates that are undesirable, such as certificates of deposit, which are currently averaging about 0.6% interest. That really helps to drive sales of these products as well, because people want to do better than what they can get at the bank or on traditional fixed UL. So those things drive sales as well.
Excellent. So we have to mention what some of our attendees might recognize as registered indexed linked annuities, but I know you like to call structured annuities. Kind of wish we could settle on one name. They're also
as long as you settle on my name, I'm fine, John.
I like structured. It's shorter. So, but talk about these products. I mean, they kind of came out of nowhere, and continue to sell extremely well. So talk about these products.
Yeah, they're really interesting because it's kind of like it's if a variable annuity and an indexed annuity had a baby together. That's what I like to say. They have features of variable annuities where you have the ability to outpace indexed annuities in terms of the interest earned. And it's also based on the performance of an outside stock market index, maybe a commodity or an ETF. But unlike indexed annuities, structured annuities have the ability to pass on losses to the purchaser. So with an index annuity, where the worst case you can get is 0, or where 0 is your hero, is the rallying cry, with structured annuities, you may be limited to only lose 10% of the market's downside, or you may be in the position to not lose anything until the market goes down more than 10% and then absorb all losses. So it has higher potential than indexed annuities, greater potential for loss. Against variable annuities, a little bit less potential for gains, a little bit less potential for loss. And they're really, really popular right now, John. One of the reasons is that insurance companies have really pushed ahead in putting them in front of people, because right now interest rates have been really bad until recently, and structured annuities compared to index annuities have greater potential for gains. So that depressed interest rate environment has really helped to press interest in these products. But the other thing is insurance companies like the pricing on structured annuities. So they're going to be trying to promote these products as much as they can. From a reserving standpoint, it's a little bit more preferable than fixed indexed annuities.
Oh, okay. So we have seen a couple of interest rates increases now, and maybe another here this month. So does that mean we should see structured annuity sales kind of level off maybe a little bit?
I actually think it's going to help structured annuity sales, just because they're based in part on bond rates. And when those rates get better, then the structured annuity rates will be better as well. But it also is going to reflect well for indexed annuity sales and multi-year guaranteed annuity sales too, John.
Okay. Okay, well, let's continue with that. As I mentioned, the economy is on a bumpy road here, and inflation is on everyone's mind. The highest inflation in 40 years, interest rates rising, potential for a recession. How is all this going to impact annuities and specifically these index products?
Well, I think it's going to be very favorable, just because we're in a situation right now where the market is declining overall. And this is a slide that shows performance back in 08, 09, which a lot of people have been comparing this period to 2008 and 2009. The thing is, at that time, it was scary because people were saying, oh, suddenly I remember it feels uncomfortable to lose money. But it was also a good time to own indexed annuities and index life because you had that floor of 0%, as I've depicted up here in the red line. Structured annuities don't have that same 0% floor, but they do have a floor on a lot of the options on most products. So that floor might be a negative amount, but it's still a floor. The thing, though, that I think is really cool about these products is that they have an annual reset. So maybe you don't lose anything and you don't earn anything, or with the structured annuity, you lose a little. But then the next year when the market comes back, or 2 years later when the market comes back, or whatever that time period is, you have the ability to cap out or earn a tremendous amount of index gains. So that's a really powerful message. And I think that overall, sales are going to be challenged, relatively speaking, because of people wanting to make sure that they have enough money in their pocket. Their spending power has been reduced. So it's going to be hard to reach optimal sales given the attitudes in the market right now. But I think that from a market perspective, it's a great time to be buying these products.
Mm-hmm. I was at a conference recently where the panel agreed that interest rates going up too fast could be bad, but if it was kind of a general increase, it might be good.
Right.
So, yeah, something to look out for. So tell us about the indexes themselves. I mean, they've really grown beyond the old traditional S&P index. So what are we seeing out there?
Well, I'll tell you what, John, this is one of the things I'm most passionate about lately, just because it's been the number one thing that's been driving sales of indexed annuities over the past decade or so. And that is the number of indexes that are available. So when I started my business 17 years ago, we had 12 different indexes upon which you could earn indexed interest in the indexed annuity market. And I'm going to focus on indexed annuity right now, even though this does affect indexed life insurance, even to some degree structured annuities. But it's most prolific on index annuities that we're seeing this. So 17 years ago, 12 different choices for your indexed interest. Let me just show you some of the choices that we have today. And you'll notice that some of these indexes have an asterisk next to them. That means that this is what I call a hybrid index. And a hybrid index is normally an index that consists of one or more other stock indexes, plus a cash or bond component. They're usually volatility controlled. They're often bespoke or proprietary to one insurance company or one parent company of the insurer. And the main thing that people really notice about them is that they don't use a cap to limit the indexed interest. They're usually using a participation rate or a spread rate. That way they can be promoted as being uncapped or unlimited potential for gains. So what we're seeing is today there's about close to 60% of all index annuity sales are allocated to a hybrid index. And when I flag through that, 150 different indexes, literally, John, 150 choices you have now today. When I look at those, 94% of them are hybrid indexes. And it's important to keep in mind that usually those indexes have little to no history on them. In fact, I often see that the index is created within days of the product that it's on launching. So I may have a new index annuity that I'm rolling out to my field force next week, and maybe the index that's available on that product has only been available for 30 days. So this has been the hottest new trend in index annuities. And really, It's something I'm keeping my eye on just because it's something that has a very big potential to be a problem if people don't understand it accurately.
Yeah, I've covered this for a while, and these hybrid indexes, it can be confusing. I mean, what is the advantage to the insurance company to have so many different pieces when they could just use the S&P? I mean, what are they getting out of doing that?
Yeah, the main thing that's really driving this, John, is illustrations. And I know that's no surprise to you, but these hybrid indexes, because they're not capped, they're illustrating very, very well. And in fact, I think the highest illustrated rate that I've seen on one is just a little over 17%. And that's 17% annually, which is just insane if you ask me. But often the insurance companies and the index providers are relying on the history of the index in order to prop up that illustrated rate. And if there's no history behind it, then what they're doing is backcasting or saying, had this index existed at this time, here's how it might have performed. But that's very disingenuous, John, because they're looking at current option pricing during a historical period. And you just can't do that because option prices change over time. And the other thing that really concerns me is that the components that make up these indexes can change and almost arbitrarily. In fact, I put together once a year this report called Wink's Index Intelligence Report, where we actually go in and do a deep dive on all of these indexes and how much sales goes into each one of them over the past 10 years. And what I found in our most recent report just over the past week is that some of these indexes components are entirely different than what they were a year ago. So you may buy an indexed annuity with an index thinking, oh, I get this. I remember what the insurance company told me it was a year ago when they rolled it out, and this is how it works. But it could be entirely different today, John. And I think one of the biggest things that concerns me is that insurance agents frequently do not do their research on indexed annuities in general. And so I think it's a stretch to expect that they would research the indexes on top of that. And some of these indexes have annual fees on them, as much as 125 basis points. So 1.25% coming off of that index as a fee to the investment bank, that has the effect of drag on the index, John, or to cross the T's and dot the I's and help connect the dots for everyone. That is going to lower the potential for index gains on the annuity. So those are the things that really concern me about these.
Yeah, I mean, if I were a consumer, trying to understand how this works, I think I would, even though I've covered this for 6 years, I think I would still be pretty confused. So, I mean, how is a typical consumer supposed to understand these things?
Yeah, I think that's a great question, John, but I have somewhat of a contrarian view because I think annuities in general are complex. I mean, they're relatively simple in the context of the life insurance world. But if you talk about the purchaser, who's probably a 63-year-old person who has maybe $150,000 in retirement funds saved up, annuities are complex because they're comparing them to a certificate of deposit or something they're already familiar with. And they certainly don't know what an annuity is. I think it's not so important that they understand the index, though, when they look at indexed annuities, because it's like me buying a car, Don. I don't understand how the engine works on my car, but I know that it goes and it does what I expect it to. And so I don't think it's important necessarily that the consumer understand the index and how the index is derived and what makes it work. But I do expect expect that the agents should know those things so that he's doing his research and only putting products in front of his prospects and clients that he feels pass the sniff test. And that is where the crux of the issue lies. And we have to remember the Safe Harbor Rule 151A says indexed annuities are fixed insurance products if they are not marketed primarily as an investment. That is the third prong of that test, if they are not marketed primarily as an investment. And so I have a good friend who passed away at the Iowa Insurance Division a couple years ago, and he said, you know, Sheryl, I respect that you think the index doesn't matter on these products and that it's a fixed insurance product no matter what, but you have to keep in mind the more that the agent is talking about these stock indexes that are more exotic, the greater potential for unregistered investment advice. And that's the concern from a regulatory standpoint, John.
Yeah, and we're going to get into the regulation of these, but okay, so the agent should be the one who understands it. But so the one you mentioned, 17%, I'm assuming, I mean, will it deliver that, do you think? I mean, is it going to come close or?
No way, no way. You have to keep in mind, these are fixed annuities, John, and they have a 0% floor. So there's a guarantee element in there. Actually, there's two guarantees because you have your floor of 0, and then you have a minimum guaranteed surrender value, which is usually based on 87.5 of premiums. And the rate that's credited on that 87.5 varies from 1 to 3%. So we've got two guarantees there. Guarantees cost money. The insurance company has an expense there, and they're using 97% of the client's money to buy bonds, which back up those guarantees. So do you think that 3% of the client's premium that they're using to buy options is really going to return 17% annually? I mean, doesn't it make sense that if that was the expectation that the indexed annuity issuer, the insurance company, would put their money into indexed annuities? I mean, I'm just using some common sense here. Is it possible that you'll get 17% ever? Sure. I have indexed annuities that have earned 15% in some years, but it is not a realistic expectation for gains on a linear basis, John.
Okay, so consumers shouldn't be reading it that way, and that's what the agent should explain, I assume.
You know, I'm not a big fan of illustrations, and that's saying a lot because I used to be an illustration software developer. And I loved the work that I did around illustrations and illustration software. But if there's one thing that I've learned from all of my 23 years in this business, it's that the only thing an illustration does is prove that ink sticks to paper. And it's a huge liability, not just for the insurance agent, but also for the insurance company, John. And so illustrations, while they can be useful tools if used appropriately, if the insurance company is initiating illustrated rates that are unreasonable, it's really hard for the producer to discern what rate should I be assuming in this if the insurance company is showing me 17%. What's reasonable? What should I show my clients?
Okay, so let's move on. I want to touch a little bit here on Index Universal Life. IUL certainly attracted a lot of attention and often not the good kind, but can you recap some of the issues with IUL?
Yeah, I mean, I think as long as we're talking about illustrations, we might as well bring that up for indexed life insurance too, because that's really where the battle over illustrated rates began. And this is something that has been an issue with indexed life since it was developed in January of 1997. Really, initially, there wasn't any guidance on how to treat indexed life insurance from an illustrative perspective because it's different than fixed UL and different from variable life. But now we have some precedents and some expectations of where that product should be illustrating. And the big problem is that the insurance companies are pushing the envelope and figuring out loopholes in the regulations so that they can illustrate something that looks much more marketable or much more favorable on paper. So the biggest problem, in my estimation, with index life is those illustrated rates are still out of control. We're hearing some problems with premium financing, and that's where you're taking a loan from a bank to fund an index life insurance product. And, some insurance companies have even taken the step of saying that they're not going to accept premium financing cases anymore, just because there have been some lawsuits around that. And then you did a major expose, if I remember, on the FIP scheme with Index Life, didn't you?
Yes, I did.
Yeah, so that was a case where we had fraud occurring with index life insurance, particularly with one FMO. And there were hundreds of life insurance policies issued that had to be rescinded and money given back to the policyholders from, I think it was 3 different home offices, if I remember right. But those policies were sold fraudulently, and really the people who bought them were taken advantage of. So it wasn't necessarily that index life was creating the problem, but it shed a negative light on index life insurance because it was the product or the vehicle that was used to perpetuate the scheme with the FIP.
Yeah, that was a pretty crazy story that I continue to follow. Okay, let's take a little break and we'll bring Ashley back in. I think we have a second poll question.
Sounds great.
The second poll we have is, what best describes your knowledge of index products? Are you very knowledgeable, somewhat knowledgeable, not very knowledgeable? And what are index products? And we'll just give you a moment to do this. Well, no one said what are index products, so that's good. But it actually seems like we're split 50-50 between very knowledgeable and somewhat knowledgeable.
Interesting. As a data nerd, I'd be interested to see if that correlates with home office people feeling very confident and insurance agents feeling like they need more confidence.
Okay, thank you, Ashley. Let's move on to my favorite topic, regulation. Regulators certainly have a lot of interest in these indexes. There you go. Talk to us about some of these, in particular AG 49, but I'll turn it over to you, Sheryl.
Yeah, so we've had a couple of regulatory items that have kept us busy on the life insurance side. Repricing for the new mortality tables and the 2017 CSO certainly was a focus for the NAIC. But then they switched to the new updated definition of life insurance with 7702. And it seems like everybody repriced their index life insurance products for both of those things. And then before you know it, AG 49 hits. And Actuarial Guideline 49 was really the NAIC's first attempt at reining in index life illustrated rates. Because I said there hadn't been any real precedence of how should you illustrate index life and how is it different from illustrating traditional UL. Some of the illustrations that were being shown were far in excess of 13% annual credited rates on index life. And like we discussed with index annuity illustrations, Sean, that's just not a reasonable expectation for gains on an index life insurance product. I mean, we're talking about a product that has guarantees and it's supposed to have limited potential for gains based on an index. And I stress the word limited. So insurance regulators tried to put forth AG 49 to rein that in. But what's really, really interesting is that within 30 days of AG 49 being made effective, we had an insurance company that had developed a new index life insurance product that had a feature called a multiplier and a bonus. And these multipliers and bonuses became very prevalent because there was a loophole in the AG 49 regulation that allowed for more attractive illustrations if you were showing this bonus or multiplier on the index life product. And so things got pretty out of control again. And I would say it was worse than before AG 49 was even passed. And then NAIC said, well, let's try again with actuarial guideline 49A. And so 49A was intended to get the bonuses and multipliers under control. But I say AG 49B with a question mark, just because NAIC is supposed to be meeting next Monday, I think, to discuss the illustration subgroup is going to discuss illustrative rates. And the A committee is keeping abreast of what's going on with hybrid indexes. Now, you remember we talked about those 150 indexes on the index annuity side. That is starting to bleed over onto index life, and where we have 60% of index annuity allocations going to hybrid indexes, it's only 26% with index life right now, but that number is growing, and we're starting to see more and more of the hybrid indexes being developed on the index life side. And that's just because the insurance company is able to get more preferential pricing. I say Sam's Club pricing on their options if they're getting more volume into those hybrid indexes. So where they maybe weren't getting enough volume with their index annuity premium only, if they added onto their index life, that helps them to achieve more volume in those hybrid indexes and the allocations there. So that helps them to get price breaks on their options. So they're going to keep perpetuating the use of these hybrid indexes on index life. And the insurance companies are kind of using that as a loophole in the AG 49A regulation. So the NAIC, I hope, in Monday's call will be addressing that and trying to discuss how we can get that under control again. But I think this is another case, John, of product developers being ahead of the regulators.
Yeah, I remember when they passed AG 49A. I don't remember the commissioner, but she made the point that they could reopen it at any time, and looks like that could happen here. So a good recap. Any other regulatory things we should be looking out for? Anything at all?
One thing that I think has the potential to get reopened based on some chatter I'm hearing from regulators is indexed annuity illustrations. We did have at one point the NAIC looking at those, and specifically hybrid indexes, because the way the illustration model reg works is that you have to show your best 10 years of the index, your worst 10 years of the index, and your most recent 10 years of the index. And a lot of these indexes, as I said, have been created within days of the product launching. So they're very new indexes with no history. And the NAIC was kind of looking at, do we want to allow an index to be illustrated if it doesn't have 10 years of history? And then another regulator kind of piped up and said, hey, why is it 10 years? Maybe we shouldn't be allowing these hybrid indexes to be illustrated unless there's 20 years of history. And so I'm hearing from some regulators that might come back, just because today, when I look at those 150 indexes, 79% of those indexes are 10 years old or less, and 87% of them are 20 years old or less. So a lot of the insurance companies' feedback is, well, it shouldn't matter that the index hasn't existed for 10 years because the components that make it up have existed for 10 years. And I would counter that and say, that really doesn't mean squat if you can change out the components tomorrow to be something entirely different.
Right. Yeah, good point. I'm still intrigued by these indexes, but so you mentioned before that products continue to evolve, and I've heard it said more than once that the product developers are staying one step ahead of the regulators. But tell us what to look for coming up with index products.
Yeah, you bet. So, when the Department of Labor proposed the fiduciary rule, we started to see fixed insurance products that were fee-based or didn't pay a commission. And we continue to see development on that, even though less than 5% of sales of annuities go into fee-based designs. We continue to see a focus on that. So new products being pumped out with fee-based compensation has been pretty common. We're seeing an increased focus on what I call a term endpoint crediting method, or that's a long-term point-to-point, where, for example, I look at the index on April 5th of 2005, and then again on April 5th of 2010, and measure any growth in the index over that 5-year period. That would be an example of a term endpoint crediting method. Those have really gotten popular just because they're often the vehicle that's used on a hybrid index crediting strategy. And the indexes have shown to have greater propensity for gains over a longer period than, say, over a 1-year annual point-to-point. But I caution people, you have to remember that with a 5-year point-to-point, for example, you could at the end of 5 years get 0%, and then your clients missed out on the potential to have 5 years worth of gains or losses there. So I often tell people, if you're going to use those long-term point-to-points, to allocate some to an annual reset indexing method. Related, I've seen restricting of liquidity on indexed annuities. Liquidity costs money, and that's one of the reasons why caps are more advantageous on those long-term point-to-points than on an annual point-to-point. But I've specifically seen insurance companies introducing new products that don't have 10% penalty-free withdrawals anymore. They're maybe only offering 5% penalty frees, or even splitting the difference and giving 7 or 8% penalty frees. Then I think outside of the hybrid indexes, which we've covered really fluently, the other trend I'm seeing is what I call buy-up caps, where it's like a traditional indexing method, except it has an annual fee on it and the rates are more advantageous. So let's say you have one S&P 500 annual point-to-point strategy with a cap of 5%. Then you might have a buy-up cap option with his S&P 500 annual point-to-point strategy and a cap of 8%, but it has an annual fee of 1% on it. And the only thing I would say about those is be cautious, because although they do have a greater potential for gains than a non-buy-up cap strategy, the client is always going to pay that 1%, regardless of what the index does. So they could get a big fat zero for their index gains and still be paying a 1% fee.
Okay, really a great recap there, Sheryl. We do have a lot of questions, but you have some more?
I would just say on the index life side, we're seeing similar trends. Mm-hmm. And those buy-up caps are actually more prolific on the index life side than they are on the indexed annuity side. And that's because they've been used to try and pump up those illustrated rates a little bit. But that was all I had on the product trends, John.
Okay. Yeah, we do have a lot of questions, but I just have one more, because you are the most enthusiastic person about annuities that I know. So I have to ask you, do you think these index products, because I know you really track the industry and the the positivity or negativity of annuity stories. I mean, do you think the index products are helping or hurting the reputation of the products overall?
I'd have to say that's split into two different responses. One for index annuities and one for index life. I don't think that it's hurting the reputation of indexed annuities just because annuities have a bad reputation to start off with. Most people don't know what they are. And if they think they know what they are, it's something different than what they really are. So an annuity is something where I give the insurance company my money, and if I die the next day, they keep it. You know, that's what a lot of people think an annuity is. So I wouldn't say it's necessarily damaging the reputation of annuities, but I would definitely say that indexed life and its complications are not doing a good job of upholding the reputation of life insurance. I would say overall, my feeling is that illustrations are damaging the reputation of life insurance and annuity products.
Okay. Okay. Great job as always. We always benefit from your knowledge. Our attendees have more questions than I had for you, so I will turn it over to Ashley to kick off our Q&A.
Awesome.
Yeah, we did get a lot of questions. Let's see where to start here. What is your recommendation for researching and analyzing specific existing and new indices?
You know, that's a really good question. And as we've been assembling Wink's Index Intelligence Report, I will tell you, as a market researcher, it's been very, very challenging to find answers. The insurance companies have worked with the index providers to often develop a microsite that supports the index and says, here are resources to explain what are the different features of this index, as well as how this index was created and what its components are. But sometimes those microsites don't cover everything. So I would advise that you just go ahead and Google the name of the index and put the word index behind it and see what kind of hits you can get. You'll usually get like a link to Bloomberg and the ticker so you can see what the performance of the index is. And then you'll also typically get that microsite that I mentioned. But if you don't find the answers that you need with those, I would go directly to the insurance company and say, I need, for example, to know what the annual fees on this index are, and I don't see it disclosed on this website. Can you help me?
Excellent advice. Is it possible or feasible to sell annuities or life insurance without an illustration? What's a better option?
Well, it is possible to sell index annuities without an illustration. It is not possible to sell index life without an illustration, with very few exceptions. If the insurance company is a fraternal insurer, you don't have to have it. If the product is guaranteed issue, you don't have to have it. But otherwise you do. And the illustration has to be signed in order for the policy to be issued. So is it possible? That depends on the product. Is it feasible to sell it without the illustration? I think it is, although a lot of people say, well, this is a tool. Okay, it is a tool, but it's being misused, and it's not helpful to the sale if everybody has unreasonable expectations, because all it does is come back to bite the agent and certainly the insurance company in the end. So what would I propose as an alternative? I'll be honest with you, I have written ad nauseum to NAIC and asked them to develop a different method for illustrating both index annuities and index life insurance. And my method would limit the illustration rate to a range of normally 1% to 2% more than what fixed insurance products are crediting on that day. So if fixed UL was crediting 4% on average, we would limit the index life illustrations to anywhere from 5% to 7% based on the market environment. Will index life do better than 7%? It absolutely could, and it probably will. But does that mean we have to illustrate it? No, because we don't have to create expectations that are unreasonable. When was the last time you heard a consumer that said, I'm so ticked off, they gave me this illustration and it shows I'm going to earn 7, but I got 12 and I'm mad about that. So yeah, I think that's a really great question. But in my eyes, illustrations can be useful, but unfortunately, the regulators are in this position where they have to be really diplomatic with the insurance companies and they have to serve the consumers in their state as well. And that's kind of hard to balance those things and still have effective regulation for illustrations.
Awesome. How would fast moving interest rates be bad?
Well, disintermediation is the first thing that comes to mind for me. So people saying this existing product that I bought has a terrible credited rate compared to this new thing that I can buy. And so let's cash surrender my existing product to take out a new product and maybe pay surrender charges on the existing product. But it could also affect the balance sheet of the insurance companies and their portfolio in terms of how much are they investing in bonds and other instruments, and how does that affect their pricing?
I know that we just touched on Googling indexes. The question that we had on that was, what are educational resources for agents that you can recommend?
As it relates to hybrid indexes, I would say those microsites, Ashley, were really the best educational resource that I can offer. They're not always sufficient, but the other things that a lot of the insurance companies have done is developed brochures or flyers about those indexes, not necessarily about the annuities that they're on or the life insurance product they're on, but that really highlights the index. And I would say that those are a tremendous resource if the insurance company offers them. But what I'm finding is that you have to look at all of those resources in sum in order to find out the information that matters. And often you can't find all the information that matters, even with everything that's provided. And that's a concern.
You may have already mentioned this, but is the structured annuity non-registered?
No, structured annuities are registered. So they are a securities product. And where I compared them to indexed annuities, that's very important to keep in mind. Indexed annuities are a fixed insurance product. Structured annuities are a registered securities product.
Thank you for clarifying that. Could you recap the pros and cons of structured versus indexed annuities?
Yeah. So structured annuities have greater potential for gains than indexed annuities do. It's not unlimited, but their caps and participation rates are usually more favorable than indexed annuities. But then on the downside, structured annuities have the potential for losses where indexed annuities do not. It's important to keep in mind, though, that usually those losses are limited. So for an example, you could say we have an indexed annuity that has a 0% floor and an annual point-to-point cap of 6%. By contrast, you may have a structured annuity, which has an S&P 500 annual point-to-point strategy that has a cap of 12%. But on the downside, there's no 0% floor. They may absorb all losses on the index above 10% loss. So if the market goes down 20%, you would lose 20% or 10%.
Interesting. What do you see as the future of RILAs and FIAs now that the lines are getting somewhat blurred between some of the products?
I think while some of it's getting blurred, there's still that very definitive break where one's a security and one's a fixed insurance product. The thing that has really intrigued me in researching the structured annuities is that they're adopting features that are very indexed annuity-like, but their rates are so much better than indexed annuities are. So I think that there's going to be a clear delineation between those in terms of product development, just because the people who sell them are totally different people. You have to be a registered rep in order to sell a securities product. And you can sell an index annuity if you're insurance licensed only. Now, that's not to say that registered reps don't sell indexed annuities, because they do. But if the interest rate environment is not favorable and the client is okay absorbing some losses or having greater potential on the offset of having a little bit of loss, then that structured annuity is going to be the natural choice. So, but what do I see in terms of product development in the future for those products? I'll be honest and say additional complexity, just because when the market and interest rate environment is very challenging, we tend to see insurance companies quote unquote innovating through their indexing methods. Historically, that has been the creation of brand new crediting methods or ways of calculating interest. At one point, I had 54 different ways of calculating index interest on indexed annuities. Or now the big trend with indexing methods is creating new indices. So I think that additional complexity is what I see ahead for both structured and indexed annuities.
Excellent. As interest rates rise, caps should rise. Should illustrated rates be allowed to move up from there?
As interest rates rise, it doesn't mean it's correlational with caps increasing, because the market's volatility also affects option prices. So if there's very volatile market conditions and you're in, say, an annual point-to-point crediting method, that could reflect poorly on your option pricing and result in a lower cap or participation rate, whatever moving part you're looking at. But what was the second part of the question, Ashley?
Oh, hang on, I just missed it. It's hard to keep track. There's so many.
I get on a tangent and then I forget.
It says, should illustrated rates be allowed to move up from there?
Oh, I personally have an unpopular opinion on that. And I don't think that illustrated rates should change when the actual caps, participation rates, and spreads on indexed insurance products change. I think there should be a range of potential illustrated rates, and that where you're choosing to illustrate in that range would be dependent on an outside benchmark. Like, for example, on indexed annuities, the 10-year treasury would be an outside benchmark. So when the 10-year treasury is really poor, then you would illustrate at the bottom of the range. And when it's doing more favorably, then you could illustrate at the top of the range. But it would be something that's determined and set in a predetermined calculation by the NAIC. That's what I would like to see. That's not how it works today.
Do you think higher rates will be good for whole life dividends?
Yes, higher rates would be good for whole life dividends, and dividends are very depressed right now. So I think that all the mutual insurance companies would like to see their dividend rates increase, but thus far, we don't have any relief with that. Dividend rates normally get set at the beginning of the year, so we'll have to see where interest rates are at the beginning of 2023 to see if that's had any impact on par whole life.
Do you see all annuities becoming registered as was threatened in the industry press 5 or more years ago?
Okay. I don't see that happening, particularly with multi-year guaranteed annuities or fixed annuities, just because they're so similar to like a certificate of deposit and very simplistic. But as I alluded to earlier in the Safe Harbor Rule 151, there's a 3-pronged test to determine if something is, or if an annuity is a security or is a fixed insurance product. And that's not, those 3 prongs are not very subjective, except for the one that says it must not be marketed primarily as an investment. And so if we continue to see a focus on illustrations and performance, and maybe even comparing index annuity potential to the stock index itself or other securities, then I think that opens that door for the 3rd prong of the test to be questioned. But I personally don't feel that other forms of annuities will be regulated as securities above and beyond structured and variable annuities the way it is today.
Okay, we have time for just a few more here. Do you have any thoughts on the trend of carriers being bought out or backed by private equity firms? And what are the pros or cons of choosing products from a carrier that is versus a carrier that isn't?
Man, that's a really long question. Keep that up, Ashley, because I might have to ask you the second part in a second.
I'm going to.
Okay, so private equity has been creeping into the insurance industry for more than a decade. And today we have a lot of insurance companies that are owned by private equity. I don't have a personal opinion that is blanket on PE in this industry where I'm saying it's a bad thing or it's a good thing. It depends on the insurance company and the private equity firm. So I own business with actually two different insurance companies that are owned by private equity. One of them I've had a really great experience and nothing has changed since before they were owned by PE. The other one, since it's the insurance company was acquired by a private equity firm, my service has gone down the hole. They've actually lost my annuity at one point. I have tons of problems with receiving annual statements. So I think it really depends on the case. Ashley, what was the second part of the question?
What are the pros and cons of choosing products from a carrier that is versus a carrier that isn't?
So the argument is that insurance companies that are owned by private equity have the ability to achieve better alpha or better returns on their investments than those that aren't PE owned, because the private equity firm is an expert at investing. I'm not an expert on private equity, so I'm not going to remark on whether or not that's true. That's just the argument. But I can say the way I can see it manifesting itself in the products that are available today is that often the private equity owned insurers have more competitive product features than companies that don't have that private equity connection. And I will say there are some insurance companies that are trying to emulate what some would call the Bermuda Triangle of having private equity insurers in addition to an investment arm and a reinsurance arm. There are insurance companies that are not owned by private equity that are trying to emulate that three-pronged approach. I would say that I include them in there in that response. Their products are typically more competitive than non-PE owned or non-Bermuda Triangle type setups.
Awesome. How are you seeing MYGA interest rates moving with rising interest rates?
The MYGA rates have been moving up, and it's been really refreshing to see. Actually, I was looking yesterday, I think I saw some 5-year MYGAs crediting 4.35% for 5 years. So that's fantastic. Makes you want to go out and buy a MYGA, doesn't it, Ashley?
Absolutely. Isn't it true that many or most of the volatility controlled indices actually underperformed over the past several years?
I would love to bow out of that and say, I don't know the answer to that because there's 150 different indexes and I haven't looked at the performance of all 150. But I would say I am well aware of multiple indexes that have returned zero that are volatility controlled. That doesn't mean that non-volatility controlled indexes haven't returned zero. In fact, during the present market environment, we're going to see a lot of zeros coming up, but there have been lawsuits that have been centered around hybrid indexes that have returned zero to the policyholder when an S&P 500 option would have returned some positive gains.
Okay. We have time for one last question here. Are there any trends that you see with living or death benefit riders in fixed indexed annuities, aside from generous features coming back, for example, higher bonuses, roll-up rates, etc.?
I'm continuing to see a focus on offering those long-term care kicker type features where you're offering an enhanced payment or payout in the event of meeting 2 out of 6 activities of daily living. I am continuing to see a focus on product development where the GLWB's benefit base is dependent on the fixed or index gains of the contract, just because that's more advantageous for the insurance company from a reserving standpoint. But in terms of product trends, what I am seeing the most of lately is increasing payouts, increasing the benefit-based bonuses, increasing the multipliers that are on those. So you kind of already hit on the things that I'm primarily seeing.
Great. Thank you, Ashley. That was a packed hour, Sheryl. We appreciate you and appreciate just being with us today.
Yeah, you bet. I appreciate the opportunity to be on here. You know, I'm always excited to talk about annuities and life insurance and get other people educated about it and pumped up. So I really appreciate the opportunity. Thank you so much.
You got it. Ashley, why don't you close us out today?
Of course. Thank you, John and Cheryl, for your insights and time today. And thank you everyone for attending today's webinar. You will be receiving an email with a recording, and please keep an eye out for information on the next webinar in this series. Have a great day.
Thanks. Bye.
Bye.